Let's figure out from Cameron Brandt from EPFR as to what's happening and what's his observation of the world is. Cameron, hi, good morning. Good to have you on the show, and thanks for staying up for us. We were just discussing Berkshire Hathaway's newsletter. Warren Buffett stating that he's investing more in Japan right now. While he still believes in US equities, he's definitely weaned off from some of his top positions in Apple and banks. But is the data suggesting that as well? Do you think a lot of money has moved to Japan and China?
Not to Japan and China. People are still building up positions as best they can see it based on the America First philosophy of the new administration. So we continue to see really pretty robust flows into all of the major U.S. fund groups. That includes liquidity funds, which I know there's been a fair amount of talk about Berkshire Hathaway's cash position. But at the moment, with sort of 7-day yields around 4%, holding cash really isn't as painful as it can be. The most significant move we've seen recently is a pretty major reappraisal of Europe. There does seem to be a feeling that if Germany takes off its debt brake, if some kind of ceasefire is imposed on the Ukraine, that there are going to be some real opportunities in Europe. So for the moment, that's where the money is going. Certainly the funds we track are not, the China dedicated ones are not seeing fresh money. Dedicated India funds, which I'm sure you're curious about, are still seeing outflows, but certainly the narrative surrounding those funds and those flows, I wouldn't say optimism is the right word, but there's certainly a recognition that India still offers pretty good growth rates. And if Trump does really start to apply the tariffs that he's been threatening, India historically has been a good defensive play there, less exposed to global trade than many certainly of your peers in Asia. Strong domestic demand component. So fund managers are being forced to sell to meet redemptions, but certainly the narrative is that they certainly haven't soured on India. There's certainly some profits too to be taken. If you use 2022 as a starting point, the dedicated India funds that we track have taken in $130 billion. So, I've been expecting for some time there'd be a bit of a reversion to the mean, some profits taken, some kicking of the tires, and that certainly seems to be going on at the moment.
Okay. Cameron, is there a way in which we can, or our audience in India can find out that how much more FI selling is left? Is there mathematically we can derive it? Do we know that what could be the canary in a coal mine which could indicate that?
There's no magic number, just the lagged ones that you can get from your central bank. But we do look at a number of data points. One is the allocations towards India of diversified funds, which is often a good clue. Those are moving sideways. But again, they have not plunged. So, I think until there's some degree of clarity about where the rhetoric about tariffs translates into actual policy, that investors are going to be in a very cautious frame of mind. And certainly US-based ones at the moment have the opportunity to just park capital in money market funds and get 4% as risk-free as it's possible. I think the current pattern is likely to persist for a while, but I don't think that you should read too much into it in terms of sort of the global investor base having soured in India. They have a lot to take in. It does seem like a good time to take profits, and we've certainly seen that in other markets that have done well. And the penalties for going to cash are just not that great right now, at least in a short-term time frame.
All right, Cameron, appreciate your time. Thank you for joining us.